Good afternoon. It's Jeffrey Christian of CPM Group. It's about 12:45 on Friday, the 12th of April here in New York. I want to talk about what is driving gold prices higher. We've seen some pretty strong increases and some sharp rises in the price. Those of you who follow CPM Group or buy our research know we have been talking about a sharp move upward in gold prices in 2024 and 2025 with record highs and big spikes. We had been expecting them that the bulk of that increase to occur in the second half of 2024 into 2025. It would seem on the surface as if it's occurring sooner than we had expected. We don't think that's the case. Our analysis suggests that prices still will rise much sharply more in the second half of this year into 2025. It's just that the demand has been greater for gold and the price has risen further than we thought it would in the first half of this year. I don't think I have a chart here on seasonality, but that does factor into the market. But I want to talk about where the gold price may go. First off, why is it rising? How far is it rising? Who's doing the buying? And what to expect going forward. So there's several factors there that we'll talk about. To understand why gold prices are rising, it's very important to note that it's not just gold and it's not just silver. By the way, price of gold shot up very sharply overnight today, and it got as high as $2,448 for the June COMEX contract. Silver got up to $29.90, up sharply too. They've both backed off a little bit. It's also important to note copper rose 10 cents this morning, and copper has been rising over the last 4 weeks, along with gold and to a lesser extent silver until today. Platinum and palladium have both risen, and both of them, platinum actually reached what we thought might be the high for the next 3 months today, and palladium got within a few dollars of what we thought might be the high for the next 3 months. So it's been across commodities and not just precious metals. As I said, copper has risen, oil prices are rising, other commodity prices are rising. And that's very important because one of the things that we've seen, which has driven all of these commodity prices high here, is a lot of investment money going into commodity index funds. One estimate was that in the last 2 weeks of March alone, about $1 billion of fresh investment dollars poured into the commodities markets. And the commodities markets are very small compared to broader financial markets. What we have been seeing over the last 8 weeks, really, is that investors have been worried about the risks. Many investors have done very well over the last 2-3 years in stock market. U.S. equities are at record prices. Other equity markets are doing pretty well. Corporate bonds, until this week, were doing very well as also. And we had a relatively strong economy, although signs of future weakness were beginning and continued to appear in the overall economy. So investors had a lot of wealth, and they were looking down the road and saying, this may be the peak for a lot of these things that we made a lot of money in. We should take some money out. We should lock in some profits, capitalize some of our gains, and we should probably seek insurance and protection. And it's very important. It's happened on a broad financial market, and you've seen that with U.S. Treasuries. The gold bugs or the snake oil salesmen like to tell you about how people are dumping treasuries. In fact, the demand for treasuries, both domestically and internationally, has risen sharply both last year and this year. Overseas holdings of U.S. Treasury securities rose 10.5% last year to a record $8 trillion. The world is not dumping treasuries, they're going into treasuries. And the reason they're going into treasuries is because U.S. Treasury securities, bonds and bills and notes, generally are seen as one of the safest, most creditworthy, lowest risk at investments that one can have. And we've seen money coming out of equity markets, real estate markets in some countries, bond markets, and other currencies going into U.S. Treasuries, seeking that security, that increased creditworthiness and decreased risk. We're seeing it in the gold market as well. We've seen investors buying large amounts of gold since 2020, but since 2021, you've seen more than 20 million ounces of gold ETFs liquidated on a market capital basis. It's not that those gold ETF investors are turned off on gold. They're trying to protect themselves from counterparty risk. They would rather own physical gold directly, have it stored someplace for them, than to own shares of an offshore company that is managed by a financial intermediary. There's a shift away from counterparty risk, showing you that investors around the world are, in fact, concerned about the stability of the financial system. We've seen this over a couple of years. Early last year, about 12 months ago, you had 3 state-chartered banks in the United States fail. That kind of spooked some investors. More importantly, Credit Suisse failed. And Credit Suisse failed for particular reasons, some of which were quasi-political. I won't bore you with the details, but here was a large international, systemically important bank. And you saw at that point, going forward to today, an increased concern about financial market stability and investors investing accordingly. So you've got counterparty risk concerns, you've got risk concerns. All comes together into this portfolio diversification, capitalizing your gains in other markets. That's really what's going on. Another piece of gobbledygook that the snake oil salesmen have been touting is, there's an entity that's buying large positions in gold or silver or options. And there are some large entities taking large positions. But what we've seen here, which is very interesting and very encouraging for metal prices to stay high, is that the demand for gold and for silver has been very widespread. It's been widespread geographically. You're seeing strong demand in North America, Europe, the Middle East, India, Southeast Asia, and China. It's really a geographically global increase in demand for gold. Less so for silver, but it's also there too. And demographically, you're seeing institutional investors, you're seeing high net worth individuals, you're seeing retail investors all buy into gold and to a lesser extent into the silver market. So it's not one large entity, and it's not just gold. Copper options are at record trading volumes and record open interest. So you're seeing this move toward lower risk portfolio diversification, and the 2 big beneficiaries are U.S. Treasuries and gold/commodities. Inflation remains a problem. We've been saying that. The Fed's been saying that. The market has been refusing to believe it. This week, the market started believing it. Recession continues to be a risk. The market had gone from expecting a recession in 2022 or 2023 or early 2024 to saying, maybe we're not going to have a recession. And now the market consensus is waking up to the fact that, yes, we will have a recession. The question is when, how deep, and how long it will be. So you have a lot of economic risks as well as financial market stability risks. And then on top of that, you have political risks too. And the political risks, as we've been saying, have become much more important to economics and financials. And they will continue to be. They're very problematic. Now, I want to run through a couple comparisons. I want to look at the way gold prices are behaving now to the way they behaved in 1979 and 1980. And then I want to focus on 2007, 2011. The latter period seems more similar to the current situation, but there are certain issues that were present in 1979, 1980 that I think make sense. First, this is what we're looking at. We're looking at a gold price that has risen 20% in the last 2 weeks. Technically speaking, it was two 10% increases. You had a 10% increase from the middle of February into early March. Then the price of gold consolidated above just below $2,200, I believe, $2,100 for much of the first half of March. And now you've had another 10% increase from that $2,000 base in mid-February. You've had another 10% increase from that base. So it's a measured move. That would suggest that perhaps the speculative spike aspect of this is now dissipating. It's not just speculative buying that has pushed gold prices and other commodity prices higher. And you have to understand it's an amalgamation of both short-term buyers who will take their profits and go away or even go short, and longer-term investors who are looking at the economic, political, or financial environment and saying, I want to have gold. It's not just gold and silver, it's commodities. This is the CRB Commodity Index. Since 2019, you can see that it rose very sharply back into early 2022, came back off, came back up in the middle third quarter of 2022, came back off, and now we're back up to where we were. This is just to put it into a larger historical perspective. You can see that in that period from 2001 to 2008, when gold prices rose sharply, it was a commodity supercycle, as the marketing hypesters wanted people to believe. And you can see that that marketing supercycle vanished in the night once we got into the recession. Now, when do gold prices spike? This is the history of gold prices again, just to point out what goes up often comes down. It doesn't go down to where it was before the spike. Gold was $190 at the end of 1978, got up to $850, came back down, and spent much of the next 15, 20 years trading between $320 and $360. With a 5-year period from 1997 to 2002, when it traded almost all the time, one spike over $300, but mostly between $250 and $300. Rose again into 2011, came down, but it didn't come back down to $320 or $360. It stayed above $1,000. And it was very funny because when the price was coming off, some guy challenged me to a bet that gold would hit $2,000 before it hit $1,000. He didn't actually challenge me. He put it in his newsletter. And it was very funny because our 10-year projections at the time didn't have gold ever going below $1,000 ever again. And it had gold going to $2,000 within 10 years. In fact, it was about 11 years before gold hit 2,000. So I didn't take the bet because I would have been betting against my own projections and predictions. But that's the quality of people who comment about gold and hold themselves out as gold experts. But let's look at 1979, 1980. At the beginning of 1979, gold was about $200 an ounce. It averaged about $225, I think, in the first month of 1979. The consensus in the market was that gold was dead. It had had a big run up in 73, 74. During that recession, the financial crisis, the quadrupling of oil prices, the end of price controls, high inflation. And then it had come down, and it was trading below $200 until the end of 1978, when gold was dead as an investment. It rose to about $300 in September, and then about $400 by the end of September, and then $850 in January of 1980. All of that was during the late stages of the economic expansion. Recession started in 1980. And when the recession started, the gold price went from $850 to $600 to $450. It then dusted itself off and ended 1980 around $600. Gold rose in the economic expansion prior to the recession. Now, it was a special time. You had 14% inflation. You had Paul Volcker take over the Fed and say, we're going to target inflation, interest rates, and ratcheted interest rates up 14% from around 7% to 21%, throwing us into that recession, actually a double-dip recession between 1980 and 1982. You had American hostages in Iran, Soviet invasion of Afghanistan, quadrupling of oil prices again. You had a lot of economic factors and political factors that in some ways are mirrored today, but in some ways are critically different. And the biggest critical difference is that back then, the way you hedged your portfolios was with gold and silver. And again, it wasn't just gold. Silver went from $5, $6 at the beginning of 79, $50 in January of 1980 to $16 in April. Copper went from 80 cents to $1.80 to 90 cents. Oil went fourfold up, twofold down. So it was a broad move in commodities that gold participated in. But the critical point in my mind is that the increase was during the late stages of the economic expansion. People had been doing well in the economic recovery and expansion from 1975 through 1979. They felt kind of wealthy. They wanted to hedge and protect their wealth against future economic storms. And so they were buying gold, similar to what we have now. But I think the bigger similarity, as I said, is really the period 2007 to 2011. In that period, and you saw the chart earlier, from 2001, 2002, gold prices and other commodity prices started rising. They rose through the economic recovery following the 2001 recession and the attack on the World Trade Center and Pentagon. The commodity prices rose from 2001, 2002, all the way into 2008 and beyond. So you saw this large, broad-based increase in commodity prices and in gold prices. By the beginning of 2008, gold had risen to a record level around $850 an ounce. It rose very sharply in January and February into the middle of March as the economic environment worsened. We had started a recession in late 2007. And the financial system's stability was called into question. Gold spiked over $1,000 that one Monday in March, the day after Bear Stearns went belly up and was sold to J.P. Morgan to take over its accounts. Within 5 trading days, the gold price was down to $906. Within a month, it was $850, and within 2 months, it was $850. Then it started to rise again. But again, you saw this early stages of a recession. So the gold price rose during the expansion and into the recession. And then it continued. This is the gold price 2007 through 2009. Now you can see how the gold price went from around $600 at the beginning of 2007 up to that $800 at the beginning of 2008, and then up to $1,000, and then back down to below $700 by September of 2008. And then Lehman Brothers went bust, and you had various other financial institutions becoming illiquid and being taken over. Merrill Lynch was merged into Bank of America. Big deal there. And the gold price then started rising again. It went back past $900 to $1,000 in early 2009, backed off a little bit, and then it went up to around $1,200 by the end of 2009. We were out of the recession then. But then it gets even better, because now, 2009 through 2011, we have an economic recovery. We're out of the recession. We're not springing back to where the economy was prior to the recession, but we are in an economic recovery phase, pretty anemic one. But there's this massive sovereign debt problem in the European Union, the ECB. It was what they called the pigs at the time: Portugal, Ireland, Italy, Spain, and Greece. All were having sovereign debt issues. And the ECB did not have the legal authority to issue the equivalent of what the Brady bonds were in 1982, which got us out of an international debt crisis in that 1981-1982 recession and period of time. The ECB didn't have the legal authority to issue the equivalent of Brady bonds in 2011. They got it in 2012 and made all the difference in their situation. But you also had persistent problems and issues with the U.S. Treasuries. And in August of 2011, Treasuries actually were downgraded for the first time in history. Just a little bit, but they were downgraded one notch for the first time in history. These are what used to be called risk-free. I think some people still call them risk-free investments, but they are the highest credit-worthy, least risky investments among mainstream investments. And they were marked down. Gold prices spiked up to about $1,900, I believe just below $1,900 in September of 2011. And then it came off. It was below $1,000 by the end of the year, and it came down, or it was below $1,600 by the end of the year, and it stayed above $1,580 until April of 2013. Then it fell from $1,580 to $1,280, and then ultimately $1,180. It stayed low for a long period of time. But this is the interesting period of time that I think has the greatest similarity to the current situation. We had gold prices rising during an expansion, into the late stages of an expansion, into a recession, through the recession, into the recovery period, and 2 years after that. We had an extended upward move in gold prices in a period of time when investors were buying 30, 40 million ounces of gold a year. And to some extent, we think that's where we are now. We're in the late stages of an economic expansion, heading toward a recession with severe financial questions about the stability of the financial markets and participants in this financial market. We don't expect the financial market to collapse. Most people don't expect it to happen, but they do think that there will be problems within the financial system. Right now, banks have started reporting their first quarter earnings, and they're pretty good. Corporations are reporting issues with their financial abilities right now. But there are signs on the horizon that we are headed toward a recession. Inflation remains an issue. There are a lot of economic and political problems that people are looking at. We assume they're going to continue to buy gold in larger portions. If the investors bought 24 million ounces of gold on a net physical basis last year, our projections are that they might buy 28 million ounces or more this year. And that's probably going to keep the gold price at record levels and move it even higher as 2024 continues and 2025 begins. So that's our economic view. Why are gold prices rising? Because investors around the world, all types of investors, are looking at the world and saying, I want to reduce my risk and I want to reduce my counterparty risk. And they're moving into U.S. Treasuries and they're moving into gold. And they're moving into commodities because commodities haven't done quite as well as stocks. That's all we have for now. Sorry it went on long, but it's a complicated story. Anybody who tells you a simple story is probably skipping over some very important details. We'll talk to you next week. Have a good weekend. Take care of yourself. Take care of those around you. Do something good for the world, and we'll see you on Tuesday.